Good Saturday morning to you, and welcome to On the Mark. Alongside Mark Papa, I'm Gary Byron. Mark is the president and CFO, CEO of Financial Resources Group out of Glastonbury, Connecticut. You can find them online at www.frplan.com, frplan.com, and at this phone number, 860-657-8380. Again, 860-657-8380. 8380. I'll repeat all points of contact more towards the end of the show. Actually, I'll probably do it a couple of times before the show is over. And Mark, oh my goodness, this has been a very successful program that he's been doing. He's got this $2,500 value. It's probably the most comprehensive checklist. I know you've heard of. There's a lot of people offering checklists, not like this. This is quite thorough. It is extremely comprehensive. So, typically, I mean, you pay for someone's time, you pay for someone's expertise. This is valued, probably even exceeds the $2,500 price tag he's putting on it. That's probably on the lower end, but you're going to get it absolutely free, and he's going to tell you all about that more towards the end of the show. There you go. Mark, good morning. Great to see you.
Hey, good morning, Gary. How are you?
Oh,
good to be back.
Not too shabby. Great. It's a Memorial Day weekend. Look at this.
I know it's always one of my favorite weekends, and hopefully the weather holds up.
I appreciate you coming in. Despite the long holiday weekend, here you are.
Well,
it's important.
Exactly, and with son's baseball games and different home family events, there's really not a lot of room to travel very far.
Any cookouts or barbecues or parades?
Oh yeah, I have my own little mix of. My favorite mixed grill of Bell & Evans chicken breast with garlic marinade, and my favorite steak tips from a certain grocery store in my town, Glastonbury, which are like melt in your mouth. Some little bit of French fries and garlic aioli is always one of my favorite little.
Are
things
you
to
hosting?
dip.
Is this at your place?
Yeah, most likely I will.
Nice.
And if I get invited somewhere, I'll certainly bring something.
Well, it's a long week, of course.
I'm usually pretty generous, and whether if it's not that, it's a nice. If I can't think about anything, you're going to get a nice bottle of wine. So
there's always more than one event going on on a long weekend. I got to tell you, things are real busy right now. And the topic, I figured that we'd go into this morning is let's talk a little bit about life insurance. And I know that a lot of people might hear those words and think, turn the station, let's turn up the barbecue. That's not for me. But you're actually going to go into why it's so integral. In fact, we're going to break this down into 4 segments lined up, including protecting younger families, building tax-free wealth, advanced estate planning strategies, and charitable giving. So let's dive right into this.
Before you change the channel, tax-free wealth, tax-free wealth, tax-free wealth. Let that sink in, okay?
Good point.
I'm just not here to convince you you're going to die.
Right. Younger adults, I'm talking about people in their 20s and 30s. A lot of them tell me, I'm young, I'm healthy, I got other places to put my money right now, I'm trying to buy a house, and I don't need life insurance right now in this stage of my life. So what do you say to them?
Well, I would say that those are, again, remember I did those investment myths, Gary?
I remember. That was about a month ago.
I should do another show on 10 life insurance myths.
Hey, that wouldn't be bad.
It wouldn't be bad. I probably should have brought it along with me this time. But the truth of the matter is the younger you are, the cheaper your life insurance is going to be. And you want to make sure, whether you're a man or woman, that you lock in that rate for as long as possible. So 30-year term insurance is a no-brainer for anyone in their 20s, 30s, or even 40s for that matter. Because if you have kids, now they're on your health insurance to 26. They may go to college. Maybe they want to go to trade school. We don't know what happens 20 years in the future, what the economy is going to look like. However, if you yourself are somebody who is young and married or young and single, and you die, you have a student loan of $200,000. The loan just doesn't go away.
No, of course not.
You're married. That falls onto your wife, who might also have student loans. So you need to cover student loans. You need to cover mortgage. You need to cover income replacement over, certain periods of time. So there's a lot of reasons to get it, and you can get it dirt cheap. I mean, you hear these ads, oh, call us and we'll quote you online. We'll get you free quotes. And they have carriers that work directly with those online companies that they have special contracts with. But Gary, I can quote over 100 companies. And you call us in, we'll do a short questionnaire, and literally we'll get you a quote within 24 to 48 hours. And then what we'll also do is help you go through your paramed exam, or sometimes it's simplified issue where they don't even ask a lot of questions. But other times, if you do have a health issue, it could be a mental health issue, or maybe you have a heart murmur, or something didn't show up so good. Maybe you had too much to drink on the weekend and went and got a blood test, whatever. You didn't show up so well. We can help you through that to make sure you get the lowest possible rate and help you through the underwriting, and also help you decide what the appropriate amount's going to be for you. So this is important stuff, but people do die, whether it's on
any age.
It could be car accident, motorcycle. It could be a heart issue. It could be an aneurysm. Who really knows?
Yeah, I heard you mention financial obligations. So let's talk about those obligations. I mean, what really is at stake for a young person here?
Well, I would say if we just go down the list, I think the big thing would be the student loans. I mean, what happens, Right, yeah. And, Gary, let me throw this plug in. Anybody who calls me, by the way, we have a estate planning. We're licensed in over 50 states. We have a service, which is a law firm licensed in the state of Connecticut. If you come in and get your life insurance with me, we'll also throw in a will at no cost or obligation. So a will at no cost or obligation. So
you're always so full of these deals and these great opportunities.
Well, yeah, I mean, we pay for it, and we do it because we're also going to be. We also offered our clients, your kids and grandkids, have to come in and do their wills, and because they're always bugging them. They're bugging the parents about to do it, but also the kids should do it, because think about this. Imagine I talked about the student loans. The average borrower graduates with over $30,000 in federal student loans. And someone's on the hook for that money, Gary. It's just not going to go away.
Yeah.
Well,
it's
true. I mean, it might go into default.
I mean, mom and dad could be on the hook for that. A lot of
if they co-sign, that's the thing. If they co-sign that student loan, guess who's on the hook?
Yeah.
So guess who needs life insurance? Right, the kids. Yeah. They're on the hook too. Otherwise, you're stuck paying that. You're going to pay that bill. So there's a lot of that going on. Absolutely, and there's also a mortgage. So if you were lucky enough to buy a home, I know it's a tough market. That could be $300,000 or $400,000, $250,000. If you're taking out a 30-year mortgage, depending on where you live here in Connecticut, if the primary breadwinner passes away unexpectedly, now that's not a good sign. Now, let's say you were the female and you decided to work from home or work part-time, so you want to raise the kids. Now you have to leave the workforce, leave the home, go back into the workforce, find a job, also possibly pay for daycare, and now you're a single mother. How are you going to do all that without a life insurance?
That's a sobering thought.
Otherwise, you're selling your house and moving into your parents again with your two kids. Or you could have life insurance that would have covered you so that you can sustain your lifestyle. And we're talking like not a lot of money, Carrie, maybe $80, $90 a month, right? Okay. To cover yourself on $1 million term policy or something along those lines. $60 I've seen. Term insurance is dirt cheap. So, you should get as much as possible for as long as possible, and get it as young as possible, because, all it takes is one bad report to the doctor, and then your price is going to go up.
Oh, yeah.
And then every year you get older, Gary, it also goes up a little bit. So we just want to make sure.
Well, everything goes up.
And this isn't going to go, your buddy that just graduated college who's now works for an insurance company, and you go buy, a whole life policy and a savings plan and all that stuff. You just need to get that term policy done. So and that's what we'll offer, and we'll also offer you, if you come in, we'll help you set up your will and all your other legal documents at no cost or obligation if you move forward on a life policy. Hopefully that moves the needle for you a little bit.
And families, we're talking children, childcare costs.
Yeah, childcare costs. I mean, they're astronomical these days, even going to I know what it costs, even after school program. An after-school program is $850 a month. That's after-school program, right? And that's not having somebody. I put my son on the bus, but That's a that's what's a pretty nice car. It's like a $60,000 car payment.
Well, that's $800. That might be $800. Yeah.
Yeah. I don't know if it's a BMW, but it's still a lot of money.
Well, we're talking about protecting the whole financial ecosystem of a young family here, right?
Yeah, absolutely. And then even the future-looking ability to send your kids to a good college as well. So you have to factor that all in. You know, I know there's a lag of kids going to college, and I know colleges are getting more and more competitive on their price. I just saw an article where the MBA programs are all major ones. They're cutting their tuition by 30 to 40% and offering big scholarships to get people to come get their MBAs now. Because it's just gotten too pricey. And the market, anything that gets too high in price, the markets like to adjust, and that's important.
So we just talked about protecting young families. Now let's talk about something maybe a little more sophisticated. I'm talking about high-income earners and a strategy called Index Universal Life, IUL. What is that exactly?
Well, I like this policy for this strategy. I'll say that it's not a one-size-fits-all solution. However, I've done this for clients that couldn't put money in a Roth IRA. They earn too much. And, there is a way they can do it. They can do a backdoor Roth, and that can be complicated if you don't know the tax rules. In fact, a lot of people, when they do a backdoor Roth, violate another rule called the backdoor rule. So if you have other IRAs, Gary, you have to calculate the value of those IRAs before you do the backdoor Roth conversion from the non-deductible IRA to the Roth IRA. So it's called the backdoor rule. And if you don't know about that rule, you could get a nice little letter from the IRS, and you'd have to pay your CPA or your tax preparer to amend your tax returns for those years and adjust your Form 8606, which I think is probably the one form that I think was ranked that had the most mistakes on it. So you have to be very, very careful. Now, if you have all your money in 401ks and you do one, then you're fine. But if you have other IRAs, you have to use, it's the sum of all our other IRAs. It's a fancy calculation. It's complicated. So another way to do this, Gary, is through Index Universal Life. And what we do is we're not looking to buy a $10 million policy here. Okay, we're not looking to buy big policy. What we are looking to do is figure out how much money you have that you can comfortably on a monthly basis, put away for your future. And then from there, what we do is we price the life insurance. We want the least amount of life insurance because we're not buying for the death benefit for the most amount of maximum cash value.
Makes sense.
Okay.
Good. Yeah.
So this is a really awesome tax shelter. And what I love about life insurance is it's triple tax free, right? So you don't get a tax deduction on the way in, but it grows tax free and comes out tax free. And when you die, it comes out to your estate tax free. So then again, it also goes into your estate. So I'm going to talk about how to avoid that. But the bottom line is it's a nice little complement to your IRA and your 401k. What I love about the Index Universal Life policies is that they give you pretty good rates. And it'll be pegged to, like, let's say the S&P 500. So they may let you earn like 10% or 12% in the S&P 500 along the way. And once you lock in your gains, you can't lose that money. So
nice.
it's there for the duration of the policy as long as you keep it in force. So that is an awesome way to build wealth, and it's also growing tax free on the way up. And you can't ever lose money unless obviously you don't meet your minimum premiums. So but but we're not doing the minimum premium. We're doing a premium, which is we're doing just so much so that the policy doesn't become what's called a modified endowment contract, and in simple terms, it becomes taxable. So we're going to go right below that number, and we're going to build that cash value as much as possible. Let's say you start in your 40s, mid 40s to early, and maybe you do it to age 65. You can really build up a big bucket of money. And then what you do, you can get that money out tax free through what's called a preferred policy loan. And typically, if you work with the right carrier, the rate will be fairly low. And now you have an extra tax-free stream of income for the rest of your life during retirement. And then when you die, if there's a death benefit left, that goes down to your beneficiaries.
All right. So this Index Universal Life, that's one answer to the question, right? There's got to be others, though.
Well, yeah. I mean, I would say that, it builds cash value over 10, 15 or 20 years. You have a nice bucket of money of tax-free savings that you can tap into. And you can also use it for things like it doesn't count towards your FASFA. So let's say you have college expenses that you wanted to borrow against the policy for. It doesn't go against your FASFA. It doesn't go against your scholarship amount or your loan grants or whatever, your college planning. So it's awesome for college planning as well.
I like how you get market-linked growth without market risk.
Yeah, and they've gotten more. These companies have been more and more sophisticated, more and more large financial institutions, private equity firms, Wall Street-oriented companies, index companies have been, are buying into life insurance companies or owning them. And what we're finding is a lot more sophisticated types of strategies that you can pick for your index. And some of them will have, let's say they'll give you a certain percentage of the S&P 500, or maybe they'll say, well, we're only going to give you 60% of the S&P 500, but we're keeping the difference. But still, they're eliminating your downside risk, and you're building this tax-free bucket of money, which I think is pretty solid. And this is in a life policy, so it all comes out tax-free.
You were talking about the modified endowment contract limit, right? Or MEC?
Yeah, the MEC, that is right. So you want to just stay just below that. That is an IRS. That's obviously an IRS rule, so that you can't. Obviously they want to limit your tax shelter. And the IRS has rules about what qualifies as life insurance versus what becomes an investment account masquerading as insurance. So that's what the threshold called modified endowment contract limit is. So we put just enough money to stay below that and keep it legal and compliant so the IRS can't tax your money.
Is it safe to say more premium is better?
Yeah, more premium is better. And
up to a point,
if you make more money, it means in order to put in more premium, you have to get a little bit more life insurance.
Okay, so then what happens to that cash value then?
Well, it grows, and then when you're ready to retire or you're ready to use it, you can take it out tax-free.
Tax-free income. Now, that's a game changer, especially for people who are in high tax brackets.
Yeah, it is. It's very big, and it can help reduce your overall tax bracket in retirement substantially, and no different from having all your money in Roth versus a regular 401k. When you add in, God forbid, if you're lucky enough to have a pension in the future, and if you're lucky enough not to have your Social Security cut by 34% in 2032, because that's another thing we'll talk about someday. That's why it's a good idea to start a policy like this so you can have that extra savings to cover that gap, because the Social Security Trust Fund is going to be insolvent, most likely by 2032, unless major changes are made. So you need additional savings vehicles that are going to be tax-free in order to cover that difference.
Who is the right candidate then for this strategy?
I would say somebody who has high income, who's a saver, somebody who has the ability to, sock away maybe $25,000 a year in addition to what they have. So I'd say most likely it's a couple. Probably making, it depends on how they lifestyle. You can make $350 and live in a McMansion, or you can make $350 and live in a condo and save your money. So it depends on who it is. But it's definitely for savers. It's definitely for those people thinking ahead. It's great for those people that maybe
people in their 40s and 50s.
30, maybe early 40s, maybe 50 at most, because the insurance gets expensive once you turn 50. So I would say if you can start something like whether you're a high earner, doctor, corporate executive, you get paid in stock and stock options. I'd say somebody making $450,000 to $500,000 a year. This is perfect for
Folks,
them.
you are listening to On the Mark, along with Mark Papa. I'm Gary Byron. Mark is president of Financial Resources Group right here in Glastonbury. You can find him online at frplan.com. And by calling this phone number, you can meet with him in person, free of charge. Listen to this, 860-657-8380. I'll repeat all of those points of contact more towards the end of the show. He can go into his $2,500 value offer that he has for you as well. Mark, okay, so we've talked about insurance for young families and as a wealth-building tool for high earners. Now let's talk about estate planning, specifically something that I was reading about called ILIT. What is that? What is that an acronym for?
All right, so that is a legal term for what they call an irrevocable life insurance trust. And you would need, I'd recommend using a qualified estate planning attorney for that trust, not the local guy who did your real estate closing, or, not your buddy. who's in litigation, you need to go to a qualified estate planning attorney. I'll put a plug in for the many different estate planning attorneys we work with. Not only do we have our own internal law firm, but when we get fancy like this, we call the lawyers.
Well,
we don't want to mess this up.
What I think is interesting, a lot of people may not be even aware of this, but you might actually owe taxes when you pass assets on to your children, right?
Yeah, so this is a big deal because this is for people who maybe let's say you own some land you're going to inherit, or you own a business, or you're a beneficiary of a business. Your business is growing. And what can happen is at the federal level, estates above a certain threshold are subject to estate tax. Currently, that exemption is $13.61 million per individual, or $27.2 million for a married couple. And that sounds like a lot of money, Gary, but there's a lot of people in that category now, especially with the way the markets have performed. They maybe not have structured their assets correctly. Anything above that number, let's say it's a business. Let's say the business doubles in valuation, and now it's a $50 million business. They're on the hook for that difference, 40%, Gary, 40% above that. So if you have a business worth 40 or 50 million and, you're taking a salary out, you need to buy one of these policies, because if you die, they may have to sell that business just to pay the taxes. And you don't want to do that because it could be the wrong time.
Yeah.
So you need to protect yourself. So, it sounds like a lot, but, for many people.
Well, above that threshold, there's a tax on the estate.
Yeah, and Connecticut has a tax above that estate on that number as well. It's 13.61 million as well, mirroring the federal level. But that can change through legislation. What happens when they get desperate? But again, at the federal level, you're 40% of everything you made, and then Connecticut goes up to as high as 12%.
So the insurance that you bought to help your family ends up creating a tax problem for you.
Well, here's the deal: you want to buy the life insurance inside the trust from the beginning. If you buy it outside the trust and then put it in the trust, it's a 3-year look back and can get called back into your estate. Again, I'm not a lawyer, but this is what I know. So you don't want that. You want to be able to structure these correctly. But if you have a $2 million policy in a $12 million estate, suddenly, and you're single, your estate could be over the threshold because your life insurance, although it comes to you personally tax-free, the life insurance policy you own could put you over that federal limit, and that percentage over the federal limit can get taxed. So that's why you want you want to put it in an irrevocable life insurance trust, because the trust owns it, and you designate a trustee and a successor trustee, and they are the ones who help you maintain the policy and control the policy. And there's more to the story, but I'll get into.
Yeah, all right. So just one final question on that, because I know we're running out of time, and there was one more I wanted to get to. But, how do you fund that trust really quickly?
Okay, so basically the way you do it, and you can't just give money to the trust whenever you want without a potential gift tax consequence. So basically what the IRS gives every individual an annual gift tax exclusion, currently about $18,000 per person, per recipient per year. Okay, that's indexed to inflation and increased in 2024. So a married couple can give $36,000 a year to each beneficiary without triggering any gift tax.
Right.
So you basically make your annual gifts to the ILET using what's called crummy notices, named after a landmark court case, tax court case, and those notices are given to the beneficiaries with a brief window to withdraw the gift, which qualifies it as a present interest gift under IRS rules, so making it eligible for the annual exclusion.
Gotcha.
That's a big, we can get into the weeds when you come and see me, but it's important that we know the mechanics, or at least talk about those mechanics.
Let's finish up. You got one more, charitable giving, because you had mentioned something called charitable remainder trust earlier. Walk us through that further.
All right. So I know we've covered a lot of ground, protecting young families, tax-free wealth building, estate planning. Let's finish up with charitable giving, and let's talk about that. So charitable remainder trust, there's many different variants of this. There's charitable remainder, charitable leads. I'm just going to talk about this. Let's talk about high-level basics. It's one of the most elegant planning tools available, particularly for people that have highly appreciated assets. Okay, and there's other strategies for that I know about, but I'm going to keep it simple today. Let's think about stocks, real estate, a business, and they want to liquidate, but they don't want to pay the huge capital gains tax bill. Okay. Mm-hmm. So
you've got an asset that's grown a lot in value, and selling it means a big tax, though, right?
Yes, exactly. Okay. So let's say you bought a piece of Connecticut real estate 25 years ago for $200,000, and now it's worth $1.2 million. Okay. And if you simply sell it, you know, there's other things you can do, but let's say in this case, you simply sell it, you owe capital gains tax on $1 million gain. The CRT offers an elegant alternative. You can transfer the asset into the trust. The trust sells it. And because the trust itself is tax exempt, there's no immediate capital gains tax, and the full 1.2 million stays intact and gets invested.
And
but
then what? Where does that money go, though?
All right. So the way this works is because it's charitable. You know, where does that money go? The trust pays you and your spouse an income stream for the period of years for your life. So basically, you get the tax break on the capital gain. You put it in the trust. It's charitable. When you die, it goes to charity. But during that period, it'll pay you income stream. The income stream is ordinary income, though. So you don't get 100% tax break, but you're still spreading the taxes out over many, many years if you do it correctly.
What happens to the remaining assets?
Well, when the remaining assets, when you die, they go to the charity.
All right. Final question then. Let's say you turn a taxable asset into a lifetime income stream, and then you leave a legacy for charity. Where does life insurance fit into any of this?
Well, basically, you know, the charitable remainder trust. I'm not sure, actually. You know, because I know most people are putting life insurance. You can put life insurance, I suppose, in that charitable. And I don't think you would want to put life insurance in there.
I need your disclaimer real quick.
Yeah. Okay. So yeah, the life insurance and the charitable remainder trust, we want to use that for a tax-free, you know, more of a wealth transfer mechanism.
Disclaimer.
Okay. Yep. I'll get to it. Okay. So the opinions expressed here during the broadcast are solely those of Mark Papa and do not necessarily reflect the views or opinions of Financial Resources Group, LLC, or any of its affiliates. All investments involve risk, including the possible loss of principal. Nothing discussed in this program constitutes an offer to buy or sell security or an investment product. Past performance is not indicative of future results. Listeners should consult with a qualified financial advisor before making any investment decisions. One last thing, Gary, you can leave life insurance to a charity, so let's not confuse that.
No, I got you.
I know there's probably some other advisors like, this guy doesn't really know. But, you know, and again, we're talking high-level stuff. I'm not, you know, we would get, if you qualify for something like this, we're going to get in the weeds.
$2,500 value entails what? It's a freebie that you're offering now.
It's a real deep dive. It's a full checklist review. We're looking to make sure we uncover benefits you owed and not aware of. We're looking for hidden risks, hidden fees, hidden taxes, things that have not been shown to you by your advisor. And we're also going to assign a consequence for not getting those things done.
It's worth more
we're
than $2,500.
We're going to get you to tell us why they need to be done, too.
It's very comprehensive. I've seen it. Extremely thorough. Folks, if you'd like to receive that complimentary and learn more about Mark and Financial Resources Group, head on over to their website, www.frplan.com, and call to schedule that consultation. There's no obligation. 860-657-8380. Again, 860-657-8380. For Mark Papa, I'm Gary Byron. Thank you so much for listening to On the Mark with Financial Resources Group. Until next Saturday morning, have a good one, everybody. So long.